Welcome to everyone that will spend their time in this sunny weather here in Stockholm, and I heard in Oslo as well, talking about global real estate. This is, as you know, a overview of what I have in my head at the moment, or things that are top of investors' mind that I try to address rather than fund pitch or deep details about the fund, which you can always acquire by your SKAGEN representatives. But if you are a newcomer, I will just briefly go through what is SKAGEN M2. It's about investing in listed real estate on a global basis in basically all sub-segments. Today we hold 33 holdings, could be typically between 30 and 35, to have a focused portfolio and not to lose the diversification. It has been up and running for almost 9 years, and we have a yearly performance net of all fees of about 6.6% in euros, and we offer daily liquidity, and that's an important point. So over to some general observations, but to understand where we are today, we have to recap a little bit what happened last year, and some of you might have seen this before, but I think it's good for the general understanding. 2020 was a lost year, more or less, for real estate investors, and it has certainly to do with the pandemic and other moving parts that we haven't seen before in synchronized movements. Basically, we have this recession going on as a result of the pandemic, with economies and segments or stories shutting down overnight, and revenue fell away. So this was clear basically not in the beginning, but pretty soon, that this was not a credit crisis that we have seen before within real estate. Companies in general had good availability to credit, and we have seen that on a global basis in general terms. We saw these disruptive forces in place, leading to a lot of speculations. One example is office. Should that exist in the future or not when everybody's working from home? And other also changing patterns of consumers that we haven't seen the end of yet, but there are some patterns that we can more or less say that they will continue. This led to obviously great polarizations in the 2020 with the resilient and growing names, and actually data center and industrials that had a kick from people working from home, or people are buying stuff from home, amplifying the already strong underlying trend that we have seen on behalf of the physical retail, hotels, etc. So actually the difference on a global basis was about 45% in US dollar terms between the high and low sub-segment. We also noticed a less good year for real estate in relation to other stocks. Actually, the difference here was about 25% return, which led us into the new year with interesting valuation for real estate. But last year also, the positive news were that there were a lot of stimulus were actually in place, but also were talked about to come in place this year. And we saw the yield bottoming of the US 10-year government bonds in late August. And after that, the turn came with the positive vaccine news. People started to get enthusiastic again. I will also say that the US election had some bearing on the positive sentiment due to all the talk about the stimulus package that could be enabled with the new president. We also experienced the value rotation. And in my segment, real estate, there were basically the COVID-19 losers, like shopping malls, hotels, and those kind of sub-segments. And we saw fast climbing bond yields that we haven't seen in a while. And this came from the inflation expectations due to the potential opening up of economies and the stimulus package that was on its going then for decision. and the bond yield climbed. So this left us with a good and attractive valuation relative set to other global stocks for real estate, and a very big polarization among subsegments. We came into the new year with bond yields surging even more that we haven't seen for a long time, and the basis for this was actually inflation expectations rather than the real interest rate moving on, i.e. the price of money. And if you have the inflation expectations, you know that this is not a very bad thing for real estate, since it could be handed over to the end client at the end of the day, with the tight connection between the leasing contracts and the inflation components that are basically in all commercial real estates anyway, that are just for the inflation. But also the housing prices are close aligned with inflation expectations, but you also moving with inflation. But you also have the main point here is that if you have inflation expectations, you typically have a very strong underlying economy. And this is the best thing you can have for real estate. So this is actually trumping potential interest rate hikes that might follow from inflation. Why is this bad with interest rate hikes? Well, two major points here. One is this is a capital intensive asset class, which means that it's typically a lot of debt, which will get more expensive. The second point is that required rate of returns typically come up, meaning that the asset value will come down. So, but we have seen the opposite, and it's quite normal in a phase like this. I will touch upon that in a minute or two. We saw and we see a record growth that is driven by the stimulus packages, and the stimulus is not in place in all economies, but certainly it is in the US. We have seen reopening effects as well, and hopes for reopenings here in Europe, but we are way behind US still. And the continuation of the catch-up from the COVID losers to the COVID winners has continued in Q1 at least. And this is a little bit my analogy with the tunnel here that you see. We all do expect to come out of the tunnel, to live a normal life, but the focus from the market participant has been extreme in this case. And one example is the hotel industry in the US. Of course, they will be traveling, and of course there is some pent-up demand for everything that we haven't been able to do the last year. But if you look at valuations, we can see, for instance, in the hotel industry, that the valuations are at the same level that they were before pandemics. And this is something that you have to be aware of, because it's very easy to get this tunnel vision of the recovery thing. So it's just a small warning. We have seen the same in the shopping centers, especially in the US, and a lot of those are very indebted and was struggling before the pandemic with growth and also with heavy debt. As I said, US lead the way. We can see that quite clear on this graph. It's the large real estate markets on top of if US, and this is in US dollars, a little bit more than 11%. The global real estate benchmark or index is up a little bit more than 9%. The global all sector index, MSCI All Country World, is up about 9%. Asia Pacific real estate, it's a big market. It's up below 7%, but still it's good. And the worst market so far, big market, is European real estate. But the interesting thing is now that the last couple of weeks we have seen an upturn, because it has been negative in US dollar term for a while. So the thesis here is that they will that Europe will go faster than US going forward, to catch up a little bit of this recovery trade that we have seen very, very clear in the US. Okay, I talked about this is a good phase for real estate, and this is the last 30 years. It's basically outlining when, if you look at the historical measures, is the best time to invest in real estate. And I claim this is the best time to reinvest in real estate. And why is that? Well, it's the early cycle that we have. Now we have left the recession, which is the worst period. You can clearly see that here. The dark blue graph is global real estate. The light blue is US real estate. The purple is global stocks or everything else than real estate. And the pink is US stocks, everything else than real estate. And why is this? One might wonder. It's pretty rational. Now we have a situation where central banks do whatever they can to push inflation and to keep interest rate low and to stimulate the economy. And this is really a time for that. Also, the government is doing everything with public spending, or we will probably experience that in the US with the infrastructure package, for instance. The reason why they do this is obvious. It's to heal a wounded economy, and they typically keep the interest rate low for a while. If you're moving further into the cycle, the returns typically come down if you look in historical perspective anyway. So this is a very good time to invest in real estate, seen to the historical data. Right on the right side, bottom down, is a little bit what I'm talking about. The central banks, they keep interest rates low to push inflation. We have seen that for many years. But what is new now is that government is using public spending to fuel the economy, and they sort of end up in a trap to fund these deficits that we're seeing in US, for instance. They have to keep more or less the interest rate low for a while. I'm not saying that interest rate will not come up. I just say I believe they will not come up very dramatically due to this reason. We also talked about inflation, and this is the big picture I want to talk about here. Inflation is something that we haven't seen for a while, but we have seen it historically, right? And when inflation has arisen, has been especially after big stimulus packages, like we saw after World War II, like we saw in the Depression in the 70s, and some other smaller initiatives on the way. Typically, this has been a very good opportunity to buy into real assets, and real assets is defined as a tangible assets. It's not very liquid, and you have an intrinsic value of it, right? So it's typically three different areas. It's commodities, it's real estate or infrastructure, and it is collectibles. Collectibles is wine, cars, art, diamonds, etc. So investors typically hold this to diversify and hedge against inflation. So on the left-hand side, this is a little bit complicated, but the dark blue line here is real assets versus financial assets. And financial assets here is bonds and stocks. So when the dark blue bar is high, real assets are relatively higher valued versus financial assets. And when the dark blue is very low, it's the vice versa. Real assets are cheap versus financial assets. The other thing that's interesting with this, and this has a 50-year history in the US, is the correlation with the inflation. There are some small gaps here and there, but the big picture is that. So real asset has a good correlation with inflation if one believes that inflation is what we're gonna have. I'm not saying we will have it in a big way, but it might come, and people are discussing that very heavily now. On the right side, you have a decomposition of different real assets. It's everything from gold to US housing, etc. Also decomposition of financial assets. And you can clearly see the correlation is quite high the last 50 years in the US. Which I think is an interesting perspective to have, even though it's a very big picture. So one should have that in the back of the head. Real assets is a good diversificator in the portfolio. That leaves us with some sort of summing up of where we are now in the global real estate space. We see that vaccine and hope for reopenings that drive recovery in fundamentals in different pace. In Europe, we are lagging, but I'm almost sure that we will not catch up maybe because US is really strong now, but we will go forward with a much better record than we have done for the last 12 months. Has also to do, of course, with the vaccine rollout. We started this year with very attractive value. We saw actually the difference between global stocks and global real estate stocks. It was a difference of 10 times the earnings multiple, and it's levels that we haven't seen since the grand financial crisis, or in the US actually even further down the road. So even though first quarter has been rather good for real estate, but we haven't catched up that gap yet. Market has priced in a lot of negatives that we saw last year. For one example is UK and retail names in UK. They actually wrote down values every month almost. And this has been priced in now, and I read basically nowhere about asset devaluations due to, and last year it was also lack of cash flow that actually took the values down. And this will change, has changed. We are in this early expansion phase, which is historically attractive for real estate. We have inflation hedge characteristics, and it's not just the CPI adjusted leasing contracts. It's also the fact that when input costs coming up, like wages and materials for building, less will be built, i.e. the supply will come down, which means that the ones that have the physical assets already in place can actually start to hike the rents. You have some sub-segments that actually can use this in real time. You have self-storage, for instance, hotels with one-night leasing contract, so they can be beneficiaries from if you have the inflation. We see, and I touched upon this before, certain sub-segments are likely, because the jury still some argumentation about this, but we know that more or less certain that e-commerce has leapfrogged the positive trend it has had with at least 3 years. We will see some revenge shopping and things like that. So we'll have a hike in shopping malls and travels and hotels and so forth. But probably we will go back to normal, and then we will end up in the situation we were before the pandemics, but with some sub-segments have moved the needle forward a little bit. I think self-storage is one of those as well. Not very big effect, but still people can now work from home. It's acceptable. We might do that for 1 or 2 days a week. Means that you have to store away your things because you live in a flat or so and you want to have somewhere to work at home. Small things like that will change the way we consume real estate. We also know there is a lot of money committed to this asset class, and interestingly enough, it's in the crossings of infrastructure as well, which is also something we know that there is a lot of money on the sideline just waiting for investing in. Towers, for instance, data center is another example, and we have seen a lot of deals this year, and I'm certainly sure that there will come more buyouts, M&A transactions, and things like that will push the segment further. Of course, there are risks, and you're all aware of those. Interest rates, if they come too fast and too much, it's not good for real estate. Bond yields, if it goes too fast and they reach levels that are too high, it's not good for anyone or any stocks at all. We all have a big problem. I don't see that. I don't see the interest rates coming up very fast either. New COVID waves, obviously, we have the third wave now. And the stock market in general. I have to mention that because we have seen a very strong stock market with the exception for last year. So that's always a risk moment. But this segment, real estate, it offers attractive income, inflation protected cash flow to releasings, and good value support at the moment still. Let's go over to the fund. The one of you that have listened to me before know that I'm always talking about the long-term view here. And SKAGEN M2 has performed or a return of about 6.6% annually after all fees since start. This year we are lagging behind a little bit, and the reason for that are one, our heavy underweight in the US. It's very hard to keep up when everything actually are going through the roof in the US. And also the subsegments, as you know, we like this defensive growth holdings. Those are the ones that has been developing more moderate in relation to the other segments like shopping malls and things that we are not overweight in. The third component is obviously Europe hasn't had its recovery race yet, which I do hope and I'm certain that we will see. And another reason is that we hold small and mid caps in some cases. Those are not on the radar for investors at this big turns that we have seen. But eventually that will come as well. And I know that many investors now are looking for small and mid cap names. So it's just a matter of time, I think. So what has performed and not performed? Typically, if you want to make life easy for yourself, it's the pandemic losers on the winning side and the pandemic winners on the losing side. But there are obviously stories behind all these cases. I will touch upon some of them later. So I think we move on here. And this is the aggregate picture. It's changing every day. But one take here is the stock selection in Japan has been bad. Also in Norway. Japan is a special case with a fallen bid, and Norway is I can't explain. I think it has to do with it's a small cap that hasn't been in favor. It's a very well-run company, strong growth profile, and very interesting name. But and also the allocation, of course, is visible here, and some currency component. It's not that much. You have seen this before. It's the barbell approach, and this is the view from a COVID-19 perspective. I choose to make this split up just to make it visible on which feet we're standing. If we start at the right side, this is the resilient steady earners, the defensive growth names. On top you have the data centers, then below you have the tower names, then comes the logistical names, then you have the rental residential names, then you have the self-storage, and you have the healthcare, aged care, or senior care. These are all names that aren't very affected by economical downturns or any other shocks for that matter. Corona was a special thing, or the COVID crisis. But these are the long-term names that are driven by long-term trends, aging population, urbanization, and digitalization, for instance. On the left side, representing at the moment 35%, you have more of a recovery theme basis. You have office names. Office will survive. It will change a little bit, but I'm pretty certain that we will return to office. Maybe not a full week, but still we have a need to talk to people face to face, etc. We also have the conglomerates with retail, hotels, and everything. We also have the pure retail names below. I will touch upon that later as well. So if I would have liked to maximize the return at any cost, I would not have any names at the right side and all my names at the left side. That will never happen because it's against my philosophy. It's very optimistic. This is about providing our investors the best risk-adjusted return or risk related to return. And that balance is very fine, and we are doing the best that we can to protect our shareholders' money. So this is the portfolio, top 10 holdings. 43%. We have a weighted target price about 22%. It's very conservative of those top 10 names. We have a little bit more of alpha generators behind this, but they are also more risky profiles in those names. So I said the last update that we will increase our US exposure. We have done that. We're almost at 25%, but it's half of the benchmark. I don't think global real estate is represented over 50% by US real estate. So I think this is a more balanced and diversified picture in our fund. Small, large, and mid cap are well balanced, and the sub-segments are also well balanced. You might remember that office was a bigger part of the pie before, but it has to do that I sold out a 5% holding, one of the largest recently. And you also have about 10% of the diversified within office. So office is actually bigger, and I will buy into more office going forward here. Healthcare is growing. And industrial logistics is growing, and this is including self-storage, data center, towers, and those kind of names. So it's very big picture here. New positions. Iguatemi, it's a Brazilian shopping center, and one might wonder why I choose to go into Brazil with a screaming pandemics at the moment. And this is actually why, because I've seen the recovery in the US, in China, and other places. And second reason for why I invest in this company is that they have the best assets there is in Brazil. It's a well-run company. A small position though in the fund still, but I think when they get their vaccination in place and things are changing, this will be a very good name to hold. Has lost about 50% since the outbreak of the pandemic. And looking at the Q4 numbers, cash collections are still very good, and the occupancy is also very good. Next name is Searland. It's a Hong Kong listed but China-based company. The reason why I bought this is also a recovery theme. They hold a shopping mall, they develop shopping mall, but they also develop housing. This is one of the largest players in China, former state-owned company. Strong balance sheet. It's one of very few that actually apply to the new 3 red line reform that the Chinese government has implemented for housing developers. It's basically balance sheet measures that has to be in place, otherwise you will get punished. And they are already in the green there. They are one of very few companies, I would say, within real estate in China that have the ability to pay their interest rates plus dividend this year from cash flow, not without lending money. So it's an interesting company with an interesting land bank, and one of the winners, I think, from the consolidation that we see among this name that is supported by the government. Cellnex and American Towers is both part of a new segment in the fund. The reason why I haven't invested in the tower industry before is mainly the price tag. It has been very expensive. American Tower, for instance, has been declining stock price-wise since May last year. And I thought now Q1 this year, it's a good entry point, and it was. Cellnex is a European tower company that are consolidating the market at the moment. And also American Tower is consolidating the market. American Tower is a global player. Cellnex is mainly a European player. But what is happening now is that a lot of telecom names are selling out their towers because they want to loosen up their balance sheet and pay down debt. So these guys are the ones buying this. And what are they doing? Well, they're owning land, and they're owning the infrastructure, the tower itself, and let the telephone companies put their gadgets on this tower with long leases, very secure cash flow. So this is a very simple explanation, but you can also, the more operators you have on your tower, for instance, if you have 3 telecom company, it's very much economies of scale in that. The last company here is CTP. I bought in that company a couple of weeks ago. It was an IPO. This is a Dutch listed company, but all the assets are in former Eastern Europe, mainly in Czechoslovakia or Czech Republic, Slovakia, Romania, and adjacent countries. They're moving into Western or Central Europe, and they have a very clear and interesting growth profile. They hold today 5 million square meters gross lease area that they have developed themselves. They will reach 10 million within 2 or 3 years. One of the reason I bought into this, besides that I really like logistics subsegment, as you all already know, is that they had a presence in former Eastern Europe that has been a little bit foreseen in this recovery race, and you have growing e-commerce, and you have a growing underlying numbers in the countries they are present. So it's a very good double effect there. CA Immo that I sold out on the right side had a lot of presence in former Eastern Europe, but on office side and some retail. So this was actually a switch when I sold out CA Immo. CA Immo had a bid, was under a bid from Starwood that came earlier this year. The problem was that this bid make the stock more or less dead, because they prolonged the bid and there came no other competitive bids. So that's why I sold it out with very good profits. But it was a company I liked though, but still I wanted to recycle the money elsewhere. Equity Commonwealth, interesting company with the idea to use the big pile of cash that they had in new ideas in US and cheap ideas arising from the pandemic, but that did not happen. So it was more or less a cash position. So we took that out. 21 Wynet sold out. It is a data center company operating in China, mainly in Beijing, but US listed. We took 45% profit in this name. It was a small position, unfortunately, but with high risk, and used the money elsewhere. John Mattsson, Swedish rental residential. We took part in the IPO in 2019, sold out with a very good profit. Hopefully, we will see the same development in the names on the left side. Some special situations in the portfolio. K. Hanshin Building, if we start with the bad news here, you might remember there were an activist bidding on the company in December last year. And K. Hanshin Building was one of the most profitable companies last year in the portfolio. They didn't reach the required amount of stocks, so the bid fell. And this activist shareholder started to sell down the shares. And this is a rather small company in relation to many other, and hence also illiquid. So that has been pushing the stock down in the first quarter. The good thing is that the board decided to implement some of the things that the activists wanted to change with the company. Share buyback, since they're trading at a huge discount. We see a very big upside in this name. And also selling down some cross-holding that they're doing in Japan. Very unnecessary to keep other company names that has nothing to do with the operation on your balance sheet. Columbia Property Trust, US office name in the gateway cities, also received an unsolicited bid 2-3 weeks ago, 25%-ish premium. The jury is still out here. Board has decided to do a strategic review, which typically means there might come other competitive bids, or they might do something to improve the company. So it's a good profit so far in this company. Same we sold out. Capital Land did something very interesting. It's one of the largest real estate companies in the world. They have basically everything, but now they choose to sell off the development at a very good price tag. The rest of the investment properties that they hold and underlying REITs, I own one of them. It's Ascendus India Trust, it's Indian office. All those assets will move over to a real estate investment management company like Blackstone or Brookfield. So you will be given a stock in this new company, some cash, at a very attractive level if you look at the valuation of the peers to Blackstone or Brookfield or whatever you might have. So that might be a very interesting Asian growth journey ahead. CK Asset Holding, Hong Kong conglomerate, has been also very successful this year on the recovery hopes. But the largest owner here is Li Ka-shing, also the founder of the company. The foundation is majority owner in this company. They have decided to sell down 4 infrastructure company to CK Asset Holding. CK Asset Holding will they will raise capital about 10%, but they have also committed to buy back 10% from the open market at a price tag much higher than when this news was announced. So what happened was that the stock price started to move upwards, and we haven't reached that level yet where they're gonna buy back shares. This hasn't been, the ink hasn't been dry in this case, but I think the deal will go through. Last thing, and I also got a question about this, is Deutsche Wohnen. Yesterday we had a very interesting and important decision coming from the Constitutional Court in Germany, saying that the rental freeze that the state of Berlin has implemented last year in February is unconstitutional, which means that it will be removed overnight and it will never be back again. This is positive news for Deutsche Wohnen, but also LEG and Grand City Properties that we hold via Aroundtown. With that said, it's election year in Germany, and it's high political pressures to do some signal effects about this. So maybe we will see some national initiatives instead. We don't know the end of this, but so far so good anyway. And yeah. Fund, you have seen this picture before. We are still cheaper, we are still less indebted, and has a higher earnings yield than our benchmark. And for those that haven't seen this before, the dividend yield is a little bit lower. And the reason for that is that we prefer companies that use their earnings into their operations instead of handing them out. So just to sum this up before questions, we are in a strong cycle for real estate, seen in a historical perspective, if that is some guidance, driven by recovering fundamentals that are in place for every day now. It's improving. There are some high expectations out there already within some sub-segments. Hotels, for instance, fundamentals is expected to be back 2023, 2024, but it's trading at levels pre-pandemic. So one has to be a little bit selective here. Inflationary environment is good for real estate and good for real assets. Increasing activity in the global real estate space. What I mean with that is that there are a lot of takeouts, a lot of M&As, and of course with that deep hole that we saw real estate was in last year, there are many companies that want to try to make a move before it's get full valued again. A lot of money is allocating into real estate and infrastructure. We know that from the allocation numbers. We also see that in terms of money pouring into the real estate funds that is held by private equity companies, for instance. There is a good momentum now with more positive news than negative news. And by that, I mean everything from we see some yield compression, for instance, in logistics in some market, very little negative news about asset devaluation and things like that. So, and this is typically a good sign of what is lying ahead. And SKAGEN M2, I think, is well positioned to grab these global trends. But there are risks in everything we're doing. We are in a stock market, so one has to beware. I'm open for questions, and I really thank you for taking your time listening to me this beautiful day. Thank you.